Gentlemen, welcome back to MGTOW Money. Today's topic, the 5 investing tips for newbies. Before we get to that, thank you to the ongoing support from the Patreon investors in this channel, as well as those men who bought me a cup of coffee via PayPal based upon the last videos. Welcome, Jeff, the newest member of Patreon supporters of this channel. Men, check the video description today. Become a Patreon supporter of this channel now. And for the book readers out there, let me briefly recommend a book by Annie Duke, who is a professional poker player, called Thinking in Bets. This is an excellent book for those men who want to improve their decision making. See the video description to a link of that book. On to today's topic, 5 investing tips for newbies. Men, I don't know about you, I didn't get any investment advice, help, etc. Almost zero education from school, parents, and so on. My PhD is won the hard way. It's from the School of Hard Knocks. Here are 5 ideas, though, that I hope will help you quickly accelerate your education. 1, don't marry your investments. Now, of course, don't marry a woman. That goes without saying. Don't marry your investments. Specifically, what I'm saying here, men, is don't get emotional and angry about your investments. In particular, as I've noticed, over the past year and a half that this channel has been around, whenever there are counter opinions, ideas that you disagree with, I have seen many comments where people seemingly are becoming hostile towards me. Remember, men, you should not have any sort of feeling toward your investment. You should not feel some sort of love, attachment, etc. to your investment. You should be looking at your investment in an impassive, non-emotional sort of way. You instead should also be looking out for alternative ideas, alternative opinions. What are you afraid of if someone is challenging your opinion regarding your investment? Are you that insecure about your idea? The bottom line is, men, don't let yourself be controlled by your biases, and in particular by your seeking out of confirmation bias. Lastly, I'll finish up by saying there'll be a video where I'm talking about when buy and hold fails. Point 2, average returns. Whenever you hear that term, well, average returns of the U.S. stock market since 1929 are approximately 9%. When you hear that phrase, men, that phrase is basically meaningless. It, of course, is based on an overall general price rise of the stock market going back to 1929. I don't know about you, I'm not going to be involved in the stock market for 100 years or whatever it might be. And furthermore, you can always pull an average, picking a random point that average might be different. An average from 2008 to 2012 shows you a net return of approximately 0. And I'll be talking about that more in just a moment. The point is, the average is not a guarantee of your future returns. It is not a guarantee of, well, if it got 7% over the past 10 years, that I can expect a 7% return on my money, and therefore it'll double in 10 years using the rule of 72. That is not necessarily the case. Again, the average return is just that. It's an average return. We don't know what the future is going to look like. 3, whenever you're buying something, whenever you make an investment in something, you basically are going to make money in one of 2 ways, and it's very simple. Either you're going to buy it and it goes up in value and you get a capital gain when you sell, key phrase, when you sell, or 2, you buy it and it generates cash flow. That cash flow, of course, could be interest, it could be a dividend, or it could be cash flow rental payments from a rental property, etc. The point is that that's basically it. Now, while I fully understand that these are not mutually exclusive, that you can, of course, buy assets that generate cash flow, that rise in value, and of course, you can get a capital gain from them, possibly. However, the point being, fundamentally, when it gets down to it, men, you only have 2 ways that you're going to make money. You're going to make money, you buy something, you buy a precious metal, you buy a crypto, it rises in value, you sell it, and therefore you've gained a capital gain, or 2, you buy it based upon cash flow. Bottom line, before you invest another dollar into something, make sure you fully understand, is this a capital gain investment or is this a cash flow investment? Because as I've mentioned in prior videos before, there are different personality types, we all have different time horizons in terms of how long we're expecting to hold this investment. In particular, when you have capital gain investments, you could end up holding them for a very long period of time before you get back to recovery, as you're going to see here in a few moments. Furthermore, when you have a cash flow investment, it can make that holding period feel a lot better. You can feel a lot more secure if at least on a regular basis, let's just say every quarter, you're getting some sort of a dividend payment or something like that, even though your investment might be down. So again, that's going to be up to you. Next idea that you need to consider: for every buyer, there is a seller. Every investment you make, whether you buy a house, whether you buy a precious metal, whether you're buying a stock, etc., someone is on the other side of that exchange. Someone is selling it to you. And correspondingly, they probably have a totally different opinion than you do. You could buy silver today, and the person who's selling it to you, guess what? They probably think that the price of silver is going to go down. So be humble enough to recognize that when you buy 100 shares of Google today, and that'll cost you about $100,000, that the person who's selling it to you has the opposite opinion, and he thinks it's going to go down. In simple terms, what I'm saying is be humble. Be willing to admit, hey, maybe I'm wrong. I could be wrong here. Maybe this investment is not going to work out how you think, because there is at least one person in the world who does disagree with your idea. And this ties into the pop quiz that I'm going to give you right now. Here's the quiz. If an asset drops, if your investment goes down 20%, it's had a 20% decline in value. It's gone from $1 to 80 cents. What percentage gain do you need to have on your investment to get back to break even? So do you need a 20% gain to get back to break even after a 20% decline? No, you actually need a 25% gain. This is a critical point that you must understand. Furthermore, I'm going to include a slide about this so you can see exactly what I'm talking about. When you have an investment that goes down, it is reverse compounding. Let's take a real life example, and I'm going to do an entire video about this. General Electric, for example, a well-known American company, in the year 2018, this year, is down approximately 30%. Therefore, shareholders in that company need approximately a 43% gain just to get back to break even. Another example, real life example, 2008, the US S&P 500 was down 37%, 37. It took 4 years, in other words, approximately 48 months, men, to get back to break even. There were a lot of people who obviously didn't have the patience, especially based upon the media, to hold that long. The point being here is that serious percentage losses, 10%, I can deal with that. 20%, I'm getting kind of nervous. 30%, now we're really getting nervous, and in particular, we're getting nervous about the hold time, etc. If you have a serious loss, it could potentially take you, as we can tell right now, potentially years. I highly encourage you. I'll include a link to a video I've done this in the past about this, about using stop losses, which is simply a method of protecting you against catastrophic declines. It could be an order that you put in with your stockbroker, or it could be just something mentally that you have in your head. So for example, if you had a huge run up in a crypto or a stock, etc., and it's gone down 50%, you say, no matter what, I am out. I'm going to take my profit, hopefully that you have a profit there, and I'm on my way. Men, let's quickly summarize what we've learned here. 1, just as I've recommended, don't marry women. You shouldn't marry your investments. And in particular, don't get emotional and angry about them. Ignore people when they talk about average returns. Again, you're not going to cross a river if it's, quote, an average of 4 feet deep. Most investors do not get the, quote, average return. Most investors, frankly, they're late on the run-up, and they sell after there's already been a serious decline. Next, for every buyer, there of course is a seller. There's always somebody on the other side of the trade. They have a totally opposite opinion of you. Be respectful of that. Be humble enough to admit, I could be wrong on this and I might have to change direction, which also ties into when you've got something that goes down in value, 10%, most of us can deal with it. 20%, most of us start getting a little nervous. 30%, most of us are beginning to lose sleep. The point being is that you need to recognize at some point your investment thesis, your forecast is wrong, and you're not going to let this turn into a serious catastrophic disaster where you're down 70 to 80%. And of course, if you're down 70%, if you look there at the slide, you've got to have a 233% gain to get back to break even. Good luck with that. Gentlemen, as always, hit the like button if you found this useful. John Galt, out.